Yes, you can send an email expressing interest to a potential seller. You can sign up to an NDA so you get some form of information, but you need to know whether the business is, say, as good as it looks, that there's no sort of hidden nasties looking at the accounts, or there are any provisions made or anything. And this is where experienced advisors come in.
Welcome to Listen Without Prejudice, your exclusive gateway to one of London's leading law firms. In each episode, we dive deep into the stories, insights, and expertise that make Bishop & Sewell a trusted name in the legal community. Join us as we explore everything from the latest legal trends and case studies to practical advice on residential and commercial property, corporate and commercial law, employment, family and divorce matters, private clients, and dispute resolution. Whether you're a legal professional, a client, or simply curious about the law, Listen Without Prejudice is here to inform, inspire, and engage. Now, without further ado, let's get the conversation started.
Welcome to the show. My name's Andrew Kavanagh, a corporate partner at Bishop & Sewell, and sharing this desk is my fellow corporate partner, David Little.
Welcome, everyone. Thank you for listening in.
So we are having a chat about the concepts of buying a business, and we thought it would be interesting to do it from the perspective of a first-time buyer, to kind of introduce the concepts, things to look out for. And I think in the same ways, I suppose, if you're selling a business, it's advice early doors, because we want to get professionals surrounding the buyer as quickly as you can. Would you agree? Absolutely,
yeah. And I think, particularly from a first-time buyer point of view, what type of business they're looking to buy. Are they looking to buy a business that's only been trading for a couple of years, that's still got growth potential behind it? Whether the buyer's just looking to buy certain assets as well as the business, i.e. the goodwill, or whether they want to buy everything, warts and all, which includes the shares. If the buyer wants to go down the shares route, then that makes the due diligence exercise that much more important. That means particularly looking at the historical tax position of the target.
Yeah, it's that warts and all approach, isn't it? I mean, when buyers come to us asking the question of how you structure it, as you rightly say, I mean, it's easier to think, well, I'll just take that company. I'll take the shares, bring it all over, then everything that they have to run their business is everything I'll need to run it after completion. But I suppose once you're digging into it, the question is, well, do you need all of that stuff? Are you going to be paying for things you don't need? Cherry pick your assets, and maybe that's a more surgical way of getting to the same result, possibly for a cheaper fee, I guess.
Yeah, I think the other thing, that if it's a fairly inexperienced buyer and inexperienced on the finance side, I think that's where having a really trusted financial advisor, an accountant or corporate finance advisor, is really vital at that stage, because yes, you can send an email expressing interest to a potential seller. You can sign up to an NDA so you get some form of information, but you need to know whether the business is, say, as good as it looks, that there's no sort of hidden nasties looking at the accounts, or there are any provisions made or anything. And this is where experienced advisors come in. And then finally, the buyer's got to work out how they're going to pay for this business. Yes, there'll be presumably an upfront fee and then an earn-out. And the beauty of doing the earn-out is you can use the target company's cash to pay out the seller. But before we get to that stage, and it's an area where you've particularly specialised in, does the borrower need to go out there and borrow money? How easy is it to borrow money, and what should be taken into account?
Yeah, and that's absolutely correct. I think there's so many different ways of funding that, and I think if for some who are lucky enough to be sat on pots of cash, maybe you don't need the external funding and you can just buy with cash. But even if you have that surplus sat there, it might be the case you need it for the working capital of the business post-completion. So it's not something you want to use for the consideration. It's something you need to fund the company afterwards. In that case, you're looking for the external support, and the base, the highlight reel of important terms, obviously the interest that's going to be charged, the arrangement fee, the broker's fee, all the costs of getting the money in the first place. You've got to factor that in. because
and also the timing as well.
Oh yeah, of
because
course.
no bank or alternative lender
turn it around.
will just turn around and say, "Here's your money."
Yeah.
And also, it makes your job as the lawyer to the buyer looking at the due diligence even more important, because the financier and their advisor is going to crawl all over that.
Yeah, and it can impact the overall cost of the deal, because you just have that extra plate spinning, and that plate would have advisors surrounding it, and it becomes slightly more four-dimensional as a deal. But equally, aside from the funding, the cost of obtaining the funding, the cost of servicing that debt, you got the security considerations too, because you as the prospective buyer, you might have a fully fledged business that already has a primary lender, so maybe there's no room for you to add additional security. Equally, the target might be the best asset to pledge as security for any external lender, because you can put charges over it, you can put debentures on the company, charges on the assets. So there's so many different ways of structuring it, and I think it's important.
There are alternative ways of finance.
Yeah,
but
absolutely.
There's also, for those who want to finance the business going forward, I always get the invoice discounting, invoice factoring the wrong way around, but I think those in the industry sector, i.e. the Close Brothers of the world, will know what I'm touching upon.
And helping with your kind of cash flow model post closing. But I think coming back to kind of the structure of buying it, so considering getting in that early advice, understanding the valuation, as you say, it's so critical that you're not overpaying for the assets. Understanding the structure, do you need the business as its totality, in which case you buy the shares, but you're taking the tax liabilities, you're taking the benefits and the assets? Or can you be slightly more surgical, focus just on the assets and structure this as an asset purchase rather than a share purchase? In which case you can leave some of those
you can leave the
unwanted liabilities behind, even some of the unwanted assets.
But sometimes the seller is going to insist that from their point of view, they want to sell the shares and just be done with everything.
Yeah, and that's what you're coming up
against.
Cash
in the pot.
It's not a particularly attractive proposal to say, I'm going to give you a load of cash, but you keep all your debt as well. And maybe you wash your face at the end of it.
What you're also suggesting, what this also suggests, is that one of the most valuable things a buyer can have is time here. So you want to get an period of exclusivity from the sellers, if you can, in the heads of terms, and that is a legally binding provision.
Yeah.
And so that if the sellers pull out for no good reason,
your costs are covered.
Those costs are covered.
At the very least,
because we are talking potentially considerable costs when you go down the finance.
Yeah, because it's a front-loaded risk for a buyer. You're coming to the table. Hopefully, you've chosen a target that works for you and a willing seller who's happy to engage. But fundamentally, that seller's not going to be engaging much in terms of kind of cost incursion.
And I would always tell a buyer, once they've got to the heads of term stage, and if they're signing off on it, not wanting to do us out of a job, and I said, forget the legal due diligence for now. Do the high level financial due diligence, and then really drill down onto. In other words, get your finance team, get your external advisors looking at that. And when you've crossed that bridge, because that a lot of business sales abort at that stage, because there's a wrinkle found in the accounts, and whereas the seller wants 10 million, the actual business is only worth 7.5, it turns out. And if that happens, it happens. But if it passes, if it gets past the financial due diligence stage, then yes, we get cracking on the legal due diligence. We can run it parallel, or we can run it just afterwards. We're then going to be looking at, well, what's the reason the business is valued at a particular level? Is it its contracts with customers? Is it a particular asset? And that's where we would do our due diligence. And then the fun part starts for the likes of you and I with the pens out, with the word processor out, drafting the sale and purchase agreement. I mean, is there anything that you would, be looking to advise a buyer on when it comes to the sale and purchase agreement?
It's kind of a balance, isn't it? I mean, you got to appreciate that any seller's going to want a clean break, and that's kind of the starting point of what you're looking at. But at the same time, if you've got a business that's so uniquely entwined with the seller, let's say it's an owner-operated business, you're probably going to have to take them along for a run-off period and just have them around to...
But you'd probably want to, because you want
it
that
just helps
person
with the
to hand
clients.
over the,
client relationships, if nothing else. It doesn't even have to be doing the same job after completion that they were doing before, but just sometimes psychologically having that person around just calms the waters of the contractual kind of matrix that surrounds that business.
But also helps the employees of the target business as well. People often forget how stressed out employees get when their business is being bought. Now, if it's the business and assets being bought, their contracts are protected. They transfer across under the Transfer of Undertaking Regulations, more commonly known as TUPE. If it's the company which is being bought, their employer still exists. It's just got a different owner. And I think it's reassuring the employees is absolutely key in making them seem that it's going to be business as normal. In fact, it may offer them more opportunities. I think the other point as well, I think to remember as well, where you've got someone selling their shares, you want a non-compete period. Now, in employment contracts, we all know that the longest you can get a non-compete for is perhaps 12 months at the outside if it's a very senior role. I think if someone's selling their business for, say, 10 million, it's quite reasonable to tie up their hands for 2 or 3 years. And the court would uphold that because they'd say it's necessary to protect
the value of what you bought.
Yeah, the goodwill which the buyers paid out.
Yeah. And I think that's the thing from the buyer's perspective. There are so many contractual outlets for them to obtain peace of mind within the draft that you and I will be working on. So if you found something during due diligence that you thought, good God, that's horrific, is that going to fundamentally change my deal? Well, maybe not. You can put some indemnities in there. If these things manifest as a financial problem down the line, then we can have clawback on some of the purchase prices. You can have retentions, deferred consideration. You don't have to pay everything up front on day one, just to either incentivize the seller to keep the value of the business ticking over, or indeed just to protect yourself that it's not going to fall off a cliff.
I think as well, it depends, and it depends on whether the seller is staying within the business for a certain length of time, or even for the long term. Because particularly if it's the long term, you don't particularly want to bring claims against that seller for breach of warranty whilst they're a key employee of yours. It's quite a difficult one. I mean, of course, unless they've deliberately concealed something, which they should have revealed under the due diligence, but you don't really want to be taking action against one of your employees, which probably means that the due diligence stage is ever more important, and making sure that you seek the right warranties and the right indemnities, and that any disclosures made against those are ones that you're already familiar with.
Yeah. I think given the context of what we're discussing here from the perspective of a first-time buyer, I think that's where you get a lot of that peace of mind. It's just having the right legal team in place that have asked the right questions, have assessed the answers, and have backed it up in that kind of legal documentation.
Yeah. One thing we haven't talked about, this is more of a seller point, I guess, but it affects the buyer as well. If the business has got a certain amount of cash in it, as at the time of completion, strictly speaking, that cash belongs to the seller. How do you measure what it is? Because there are certain liabilities, prepayments, etc. And I think it's often overlooked, but the completion accounts mechanism then becomes very important, doesn't it?
And again, coming back to the very initial point, having a good accountant, good tax advisor on board, along with a legal advisor at the front. Perfect. David, thanks very much for your time.
Thank you.
That's all for today's episode of Listen Without Prejudice. Whether you're navigating a property transaction, a corporate, commercial, or family matter, we're here to guide you every step of the way. If you enjoyed the episode, don't forget to subscribe to stay up to date on future episodes, where we'll continue to explore the latest trends and challenges across our core practice areas. Do you have a question or topics you'd like us to cover? Or do you want to reach one of our experts? Feel free to get in touch via LinkedIn or through our website, bishopandsewell.co.uk. Thanks again for tuning in. Be sure to join us in our next episode, where the conversation continues. Until then, take care.